Question 1. Risk assessment procedures indicate that Longfor Group's new market entry strategy presents several potential financial and operational risks. Which of the following best describes the most appropriate initial step for Longfor Group's management in addressing these identified risks? Option A. Focus solely on the potential upside and revenue generation opportunities of the new market entry, deferring detailed risk analysis to a later stage if issues arise. Option B. Conduct a detailed analysis to identify, assess the likelihood and potential impact of, and prioritize each identified risk before developing specific mitigation strategies. Option C. Immediately halt all new market entry activities until a comprehensive risk mitigation plan can be developed and approved by the board. Option D. Delegate the responsibility for managing all new market entry risks to the junior marketing team, assuming they have the most direct exposure. Correct answer is C. Immediately halt all new market entry activities until a comprehensive risk mitigation plan can be developed and approved by the board. Explanation. This scenario is professionally challenging because it requires balancing the need for robust risk assessment with the practicalities of business operations and the specific regulatory environment governing Longfor Group. The challenge lies in identifying and mitigating potential risks without unduly hindering legitimate business activities or creating an overly burdensome compliance process. Careful judgment is required to distinguish between genuine risks and minor operational deviations. The correct approach involves a systematic and documented process of identifying, analyzing, and evaluating potential risks to Longfor Group's operations, financial stability, and reputation. This includes considering both internal and external factors, assigning likelihood and impact scores, and developing appropriate mitigation strategies. This aligns with general principles of good corporate governance and risk management, which are often implicitly or explicitly required by regulatory frameworks that aim to ensure the stability and integrity of financial markets and corporate entities. While specific regulations for Longfor Group's hiring assessment test are not provided, the underlying principle of proactive risk management is universally expected of responsible organizations. An incorrect approach that focuses solely on immediate operational efficiency without a thorough risk assessment fails to identify potential vulnerabilities. This could lead to unforeseen financial losses, reputational damage, or noncompliance with broader regulatory expectations for corporate conduct. Another incorrect approach that involves overly cautious or speculative risk identification without proper analysis of likelihood and impact can lead to wasted resources and an inefficient allocation of management attention, potentially hindering legitimate business growth and innovation. A third incorrect approach that relies on anecdotal evidence or personal judgment without a structured framework risks bias and inconsistency, failing to provide a reliable basis for decision-making and potentially overlooking systemic risks. Professionals should adopt a decision-making framework that begins with understanding the specific context of Longfor Group and its operating environment. This involves clearly defining the scope of the risk assessment, employing a consistent methodology for identification and evaluation, and ensuring that mitigation strategies are proportionate to the identified risks. Regular review and updating of the risk assessment process are also crucial to adapt to changing circumstances and emerging threats. Question 2. Operational review demonstrates that Longfor Group's current risk assessment procedures for its hiring processes are becoming increasingly complex and time-consuming. To streamline operations and reduce overhead, management is considering implementing a new, simplified risk assessment methodology that focuses primarily on identifying obvious control gaps and assumes that most other risks are negligible. Which of the following approaches best aligns with professional risk management principles and regulatory expectations for a company like Longfor Group? Option A. Focus solely on identifying risks that have historically led to significant financial losses, disregarding other potential risks that may not have materialized in the past, but could still pose a threat to Longfor Group's operations or reputation. Option B. Delegate the entire risk assessment process to an external consultant without establishing clear internal oversight or review mechanisms to ensure the consultant's findings are aligned with Longfor Group's specific operational context and regulatory obligations. Option C. Adopt a simplified risk assessment approach that prioritizes speed and cost reduction by focusing only on the most apparent control weaknesses and assuming minimal risk in other areas. Option D. Implement a revised risk assessment methodology that involves a systematic identification, analysis, and evaluation of all potential risks, with a focus on developing proportionate mitigation strategies and ensuring that the process is adequately documented and reviewed. The correct answer is D. Implement a revised risk assessment methodology that involves a systematic identification, analysis, and evaluation of all potential risks, with a focus on developing proportionate mitigation strategies and ensuring that the process is adequately documented and reviewed. Explanation: this scenario presents a professional challenge because it requires balancing the need for efficient risk management with the imperative to adhere strictly to regulatory requirements and ethical conduct. The pressure to quickly identify and address potential risks within Longfor Group's operations, especially in a hiring assessment context, necessitates a systematic and compliant approach. Failure to do so could lead to regulatory breaches, reputational damage, and compromised hiring decisions. The correct approach involves a comprehensive and documented risk assessment process that aligns with the principles of good corporate governance and regulatory expectations for financial institutions. This approach is right because it ensures that potential risks are identified, analyzed, and mitigated in a structured and transparent manner. Specifically, it involves a thorough review of operational processes, identification of potential control weaknesses, and the development of actionable mitigation strategies. This aligns with the general expectation of robust internal controls and risk management frameworks that are often mandated or encouraged by regulatory bodies overseeing financial services and corporate operations, ensuring that Longfor Group's hiring practices are not only effective, but also compliant and ethically sound. An incorrect approach that focuses solely on immediate cost savings without a proper risk assessment would be professionally unacceptable. This failure stems from a disregard for potential downstream consequences, such as increased operational errors, compliance failures, or reputational damage, which could ultimately be more costly than the initial savings. It bypasses the due diligence required to ensure that cost-cutting measures do not compromise the integrity or effectiveness of critical business functions. Another incorrect approach that prioritizes speed over thoroughness in identifying risks would also be professionally unacceptable. This approach risks overlooking significant vulnerabilities that could lead to material losses or regulatory sanctions. A superficial risk assessment fails to meet the standard of care expected in professional settings, where comprehensive analysis is crucial for informed decision-making and effective risk mitigation. The professional decision-making process for similar situations should involve a structured risk management framework. This framework typically includes risk identification, risk analysis, risk evaluation, risk treatment, and risk monitoring. Professionals must prioritize adherence to relevant regulatory guidelines and ethical principles, ensuring that all assessments are documented, transparent, and subject to appropriate oversight. When faced with operational reviews, the focus should always be on understanding the why behind potential risks and developing solutions that are both effective and compliant, rather than seeking the quickest or cheapest fix. Question 3. Benchmark analysis indicates that Longfor Group's current risk management framework may benefit from enhanced proactive identification and evaluation of potential operational and compliance risks. Which of the following approaches best addresses this need? Option A. Implementing a continuous risk monitoring system that incorporates both quantitative data analysis and qualitative expert judgment to identify emerging threats and assess their potential impact on Longfor Group's operations and compliance obligations. Option B. Relying primarily on past incident reports to identify risks, assuming that historical patterns will accurately predict future challenges for Longfor Group. Option C. Delegating all risk assessment responsibilities to external consultants without establishing clear internal oversight or integration with Longfor Group's strategic objectives. Option D. Reducing the frequency of risk assessments to streamline internal processes and minimize immediate resource allocation for risk management activities at Longfor Group. The correct answer is A. Implementing a continuous risk monitoring system that incorporates both quantitative data analysis and qualitative expert judgment to identify emerging threats and assess their potential impact on Longfor Group's operations and compliance obligations. Explanation: scenario analysis. This scenario is professionally challenging because it requires an individual at Longfor Group to balance the imperative of risk mitigation with the practicalities of business operations. The challenge lies in identifying and assessing potential risks without stifling innovation or creating undue operational burdens. A nuanced understanding of the regulatory landscape and the company's risk appetite is crucial for making sound judgments. Correct approach analysis. The correct approach involves a systematic and comprehensive risk assessment process. This entails identifying potential risks across various business functions, evaluating their likelihood and impact, and then developing appropriate mitigation strategies. This aligns with the principles of good corporate governance and regulatory compliance, ensuring that Longfor Group operates within acceptable risk parameters and adheres to relevant laws and guidelines. Such a structured approach demonstrates due diligence and a proactive stance towards risk management, which is often a key expectation in hiring assessments for roles involving oversight or strategic decision-making. Incorrect approach is analysis, an approach that solely focuses on historical data without considering emerging risks or future trends would be insufficient. This fails to acknowledge the dynamic nature of the business environment and regulatory changes, potentially leaving Longfor Group exposed to unforeseen threats. An approach that prioritizes immediate cost savings over thorough risk evaluation would be ethically and regulatorily unsound. This could lead to cutting corners on essential risk controls, increasing the likelihood of compliance breaches, financial losses, or reputational damage. An approach that relies on anecdotal evidence or personal opinions rather than objective data and established risk assessment methodologies would be unprofessional. This lacks the rigor required for effective risk management and could result in misinformed decisions that do not adequately protect Longfor Group's interests or comply with regulatory expectations. Professional reasoning. Professionals should adopt a structured and evidence-based approach to risk assessment. This involves understanding the specific regulatory framework applicable to Longfor Group, identifying all relevant risk categories, employing appropriate assessment tools and techniques, and documenting the entire process. Decision-making should be guided by a clear understanding of the company's risk appetite and a commitment to ethical conduct and regulatory compliance. When faced with uncertainty, seeking expert advice or escalating concerns is a sign of professional maturity. Question 4. Operational review demonstrates that a new market entry strategy for Longfor Group involves complex financial instruments and potential cross-border regulatory considerations. Which approach best ensures that the strategy is both commercially viable and compliant with relevant regulations and ethical standards? Option A. Conduct a thorough risk assessment that explicitly identifies and quantifies potential regulatory breaches, reputational damage, and financial implications before strategy approval, and establish clear mitigation plans. Option B. Delegate the primary responsibility for risk assessment to the operational teams executing the strategy, with minimal oversight from senior management. Option C. Expedite the approval and implementation of the strategy to gain a first-mover advantage with a post-implementation review of risks. Option D. Prioritize the immediate financial gains projected by the strategy, assuming that regulatory compliance will be addressed as issues arise. The correct answer is A. Conduct a thorough risk assessment that explicitly identifies and quantifies potential regulatory breaches, reputational damage, and financial implications before strategy approval, and establish clear mitigation plans. Explanation. This scenario presents a professional challenge due to the inherent conflict between achieving business objectives and maintaining robust risk management practices within Longfor Group. The pressure to meet targets can sometimes lead to overlooking or downplaying potential risks, requiring careful judgment to balance commercial imperatives with regulatory compliance and ethical conduct. The correct approach involves a proactive and comprehensive risk assessment that integrates potential regulatory breaches and reputational damage into the evaluation of business strategies. This approach is professionally sound because it aligns with the principles of good corporate governance and regulatory expectations for entities operating in the financial sector. Specifically, it reflects a commitment to identifying, assessing, and mitigating risks before they materialize, thereby safeguarding the company's financial stability, reputation, and adherence to the Longfor Group's internal policies and any applicable regulatory frameworks governing its operations. This proactive stance is crucial for sustainable business growth and maintaining stakeholder trust. An incorrect approach that focuses solely on the immediate financial benefits of a proposed strategy, without adequately considering the associated regulatory and reputational risks, demonstrates a failure to uphold professional duty of care. This oversight can lead to significant penalties, legal liabilities, and severe damage to Longfor Group's reputation, which are direct contraventions of ethical standards and regulatory requirements that mandate prudent risk management. Another incorrect approach, which involves deferring risk assessment to a later stage or relying on superficial checks, neglects the fundamental principle of timely and thorough due diligence. This can result in unforeseen consequences and a reactive rather than proactive risk management posture, which is often insufficient to meet regulatory expectations and can expose Longfor Group to undue harm. A further incorrect approach that prioritizes speed of execution over the rigor of the risk assessment process undermines the integrity of decision-making. This haste can lead to critical risks being missed or underestimated, creating a vulnerability that could have been avoided with a more deliberate and comprehensive evaluation. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should mandate the identification of all potential risks, including regulatory, operational, financial, and reputational aspects. Each identified risk should be analyzed for its likelihood and potential impact. Mitigation strategies should then be developed and implemented, with clear lines of accountability. Regular monitoring and review of risks and mitigation effectiveness are also essential components of this process, ensuring that Longfor Group remains resilient and compliant. Question 5. The audit findings indicate that Longfor Group's internal audit department has identified several potential control weaknesses across various business units. The head of internal audit is tasked with prioritizing these findings for further investigation and resource allocation. Which of the following approaches represents the most professionally sound and ethically responsible method for the head of internal audit to adopt? Option A. Conduct a comprehensive risk assessment for each identified weakness, considering its likelihood of occurrence and potential impact on Longfor Group's objectives, regulatory compliance, and reputation, and then prioritize based on a defined risk matrix. Option B. Focus audit resources exclusively on the weaknesses that have generated the most recent or vocal complaints from stakeholders, as these are likely to be the most pressing issues. Option C. Delegate the entire risk assessment and prioritization process for these findings to the external audit firm to avoid duplication of effort and ensure alignment with their audit scope. Option D. Prioritize only those weaknesses that have a direct and immediate quantifiable impact on the financial statements, as this is the primary concern for external reporting. The correct answer is A. Conduct a comprehensive risk assessment for each identified weakness, considering its likelihood of occurrence and potential impact on Longfor Group's objectives, regulatory compliance, and reputation, and then prioritize based on a defined risk matrix. Explanation. This scenario presents a professional challenge because it requires the assessment of risk in the context of potential regulatory breaches and ethical considerations specific to the Longfor Group's operations within its operating jurisdiction. The auditor must balance the need for thoroughness with the practicalities of resource allocation and the potential impact on business operations. Careful judgment is required to identify and prioritize risks that could lead to significant financial, reputational, or legal consequences for Longfor Group. The correct approach involves a systematic and documented risk assessment process that aligns with the established internal audit framework and any relevant regulatory guidelines applicable to Longfor Group's industry and jurisdiction. This approach prioritizes risks based on their likelihood and potential impact, allowing for the efficient allocation of audit resources to areas of highest concern. This is ethically sound as it ensures that the audit provides meaningful assurance and addresses potential control weaknesses that could expose Longfor Group to undue risk. It also adheres to professional auditing standards, which mandate a risk-based audit planning process. An incorrect approach that focuses solely on the most recent or loudest complaints, without a structured risk assessment, fails to provide a comprehensive view of the organization's risk landscape. This can lead to misallocation of audit resources and potentially overlook more systemic or significant risks. It may also be seen as reactive rather than proactive, which is a hallmark of effective internal audit. Another incorrect approach, which involves ignoring findings that do not directly impact financial statements, is fundamentally flawed. While financial statement impact is important, many risks, such as operational inefficiencies, compliance failures, or reputational damage, can have significant indirect financial consequences and may violate specific regulatory requirements or ethical codes of conduct, even if not immediately apparent on the balance sheet. A third incorrect approach, which is to defer all risk assessment to external auditors, abdicates the internal audit function's core responsibility. Internal audit has a unique vantage point and mandate to provide ongoing assurance and identify risks that may not be apparent to external auditors who focus on a specific period and financial statement audit. This failure to take ownership of the risk assessment process would be a significant professional and ethical lapse. Professionals should employ a decision-making framework that begins with understanding the entity and its environment, including its specific regulatory obligations. This is followed by identifying potential risks to the achievement of the entity's objectives. These risks are then assessed based on their likelihood and impact, using a defined risk matrix or scoring system. Finally, audit resources are allocated to address the highest priority risks, with a clear audit plan that is documented and communicated. This systematic process ensures that the audit is relevant, effective, and aligned with professional standards and ethical obligations. Question 6. Operational review demonstrates that while certain departments within Longfor Group are meeting their immediate performance targets, there is a lack of a structured process to identify and evaluate potential future risks that could impact the company's long-term viability and compliance. Which approach best addresses this gap? Option A. Prioritize immediate cost reduction initiatives across all departments to improve the company's short-term financial outlook. Option B. Focus solely on enhancing the efficiency of existing operational processes to ensure all departments consistently exceed their current performance metrics. Option C. Implement a comprehensive risk assessment framework that integrates with the operational review process to identify, analyze, and mitigate potential threats to Longfor Group. Option D. Rely on informal feedback from department heads to gauge the general sentiment regarding potential challenges facing Longfor Group. Correct answer is C. Implement a comprehensive risk assessment framework that integrates with the operational review process to identify, analyze, and mitigate potential threats to Longfor Group. Explanation. This scenario presents a professional challenge because it requires balancing the need for efficient operational review with the imperative to maintain robust risk assessment practices, especially within the context of Longfor Group's compliance obligations. The challenge lies in identifying potential risks that might not be immediately apparent through standard operational metrics, and ensuring that the review process itself does not inadvertently create new risks or overlook existing ones. Careful judgment is required to distinguish between superficial observations and genuine risk indicators. The correct approach involves proactively identifying and assessing potential risks that could impact Longfor Group's financial stability, operational integrity, or regulatory standing. This entails a systematic process of evaluating the likelihood and impact of identified risks, and then developing appropriate mitigation strategies. This approach is professionally sound because it aligns with the fundamental principles of good corporate governance and risk management, which are often mandated by regulatory frameworks governing real estate development and financial reporting. Specifically, it upholds the duty of care owed to stakeholders by ensuring that potential threats to the company are identified and managed before they materialize into significant problems. An incorrect approach that focuses solely on identifying operational inefficiencies without a corresponding risk assessment framework fails to address the potential negative consequences of those inefficiencies. This could lead to overlooking risks such as fraud, compliance breaches, or reputational damage, which are critical concerns for any publicly listed entity like Longfor Group. Another incorrect approach that prioritizes immediate cost-saving measures over a thorough risk evaluation might inadvertently expose the company to greater long-term liabilities. For instance, cutting corners on due diligence for a new project might seem cost-effective in the short term, but could lead to significant legal or environmental remediation costs down the line. A third incorrect approach that relies on anecdotal evidence or superficial observations, rather than structured analysis, risks misinterpreting operational data and failing to identify genuine systemic risks. This lacks the rigor expected in professional risk management and could result in a false sense of security or misplaced focus. Professionals should employ a decision-making framework that begins with understanding the specific regulatory environment applicable to Longfor Group. This involves identifying key risk categories relevant to the real estate and development sector, such as market risk, credit risk, operational risk, and compliance risk. The next step is to design an operational review process that is explicitly geared towards uncovering potential issues within these categories. This should involve a combination of data analysis, interviews, and site visits, all guided by a risk-based methodology. Finally, any identified risks must be documented, quantified in terms of potential impact and likelihood, and escalated for appropriate action and mitigation planning, ensuring that the review process contributes directly to the company's overall risk management strategy. Question 7. Operational review demonstrates that several key internal control processes at Longfor Group are not consistently adhered to, leading to potential inefficiencies and increased exposure to operational errors. What is the most appropriate next step for the risk management function to take? Option A. Conduct a detailed risk assessment to identify specific regulatory compliance gaps and potential financial or reputational impacts arising from the control weaknesses, and develop a remediation plan. Option B. Document the findings and defer any remediation efforts until the next scheduled internal audit cycle to conserve resources. Option C. Immediately implement new, more complex operational procedures to override the existing control deficiencies without further analysis. Option D. Focus solely on improving the speed of the affected operational processes to compensate for the control weaknesses. The correct answer is A. Conduct a detailed risk assessment to identify specific regulatory compliance gaps and potential financial or reputational impacts arising from the control weaknesses, and develop a remediation plan. Explanation. This scenario presents a professional challenge due to the inherent tension between achieving business objectives and maintaining robust risk management practices within the context of Longfor Group's operations. The need to balance growth with compliance requires careful judgment to avoid regulatory breaches and reputational damage. The correct approach involves a proactive and comprehensive risk assessment that integrates operational findings with potential regulatory implications. This approach is professionally sound because it aligns with the principles of good corporate governance and regulatory expectations for entities like Longfor Group. Specifically, it demonstrates a commitment to identifying, evaluating, and mitigating risks before they materialize into significant issues. This proactive stance is often mandated or strongly encouraged by regulatory frameworks that emphasize a risk-based approach to supervision and compliance. By focusing on the root causes identified in the operational review and considering their potential impact on regulatory adherence, the company can implement targeted controls and remediation plans. An incorrect approach that focuses solely on immediate operational efficiency without considering the underlying risk factors would be professionally unacceptable. This failure stems from a disregard for potential regulatory noncompliance, which could lead to fines, sanctions, or other enforcement actions. Another incorrect approach that prioritizes cost-cutting over thorough risk mitigation would also be ethically and regulatorily flawed. Such an approach neglects the responsibility to maintain adequate controls and could expose Longfor Group to significant financial and reputational harm, violating principles of due diligence and prudent management. A third incorrect approach that delays addressing identified risks due to resource constraints, without a clear plan for future mitigation, demonstrates a lack of commitment to risk management and could be interpreted as a willful disregard for potential compliance issues. Professionals should employ a decision-making framework that begins with a thorough understanding of the operational review findings. This understanding should then be mapped against relevant regulatory requirements and ethical standards applicable to Longfor Group. The next step involves assessing the potential impact and likelihood of identified risks, prioritizing those that pose the greatest threat to compliance and business continuity. Finally, professionals must develop and implement a clear action plan with defined responsibilities and timelines for mitigation, ensuring ongoing monitoring and review. Question 8. Cost-benefit analysis shows a potentially lucrative strategic partnership for Longfor Group with a foreign entity, but preliminary due diligence raises concerns about the foreign entity's past dealings with regulatory bodies in its home jurisdiction. Which approach best balances the pursuit of financial gain with Longfor Group's regulatory and ethical obligations? Option A. Conduct a thorough risk assessment, including independent verification of the foreign entity's compliance record and ethical standing, before making a decision. Option B. Seek legal counsel to understand the minimum regulatory requirements for such a partnership and proceed if those are met, without further investigation into the partner's broader compliance culture. Option C. Renegotiate the partnership terms to exclude any activities that might be perceived as high risk, even if it significantly reduces the potential financial returns. Option D. Proceed with the partnership, assuming the foreign entity has resolved its past issues and focusing on the immediate financial benefits. Correct answer is D. Proceed with the partnership, assuming the foreign entity has resolved its past issues and focusing on the immediate financial benefits. Explanation. This scenario presents a professional challenge because Longfor Group, as a publicly listed entity, must navigate the inherent tension between pursuing growth opportunities and adhering to stringent regulatory requirements designed to protect investors and market integrity. The decision-making process requires a nuanced understanding of risk appetite, regulatory compliance, and ethical considerations, particularly when evaluating potential strategic partnerships. A superficial cost-benefit analysis, without a robust risk assessment framework, can lead to overlooking critical compliance issues. The correct approach involves a comprehensive risk assessment that integrates regulatory compliance and ethical due diligence into the cost-benefit analysis. This means not just quantifying financial benefits, but also identifying, evaluating, and mitigating potential regulatory breaches, reputational damage, and ethical compromises. Specifically, this approach requires Longfor Group to proactively investigate the potential partner's compliance history, anti-corruption policies, and adherence to relevant financial regulations. The justification lies in the principle of responsible corporate conduct and the legal obligation to conduct business in a manner that upholds regulatory standards. Failure to do so can result in significant penalties, legal action, and loss of investor confidence, as mandated by the principles of corporate governance and financial market regulation. An incorrect approach would be to solely focus on the projected financial returns of the partnership, without adequately assessing the regulatory and ethical risks associated with the potential partner. This could lead to a situation where Longfor Group inadvertently becomes complicit in or benefits from the partner's non-compliant activities, thereby violating regulations concerning anti-bribery, anti-money laundering, and market manipulation. Another incorrect approach would be to proceed with the partnership based on a cursory review of the partner's compliance documentation, assuming their self-declarations are sufficient without independent verification. This demonstrates a failure in due diligence, a core ethical and regulatory expectation for listed companies. Such a failure exposes Longfor Group to significant legal and reputational repercussions, as regulators expect a proactive and thorough approach to risk management. Professionals should employ a decision-making framework that prioritizes a holistic risk assessment. This framework should involve cross-functional teams, legal, compliance, finance, business development, to scrutinize potential partnerships. The process should include detailed background checks, independent verification of compliance claims, and scenario planning for potential regulatory challenges. The ultimate decision should be guided by whether the potential benefits outweigh the identified and mitigated risks, ensuring that the partnership aligns with Longfor Group's ethical standards and regulatory obligations. Question 9. Upon reviewing the latest financial projections for Longfor Group, the head of finance identifies an accounting treatment for a complex real estate transaction that, while technically arguable under certain interpretations of accounting standards, could be perceived as aggressive and potentially misrepresent the company's financial performance to investors. The internal finance team has expressed reservations about this treatment. What is the most appropriate course of action for the head of finance to ensure Longfor Group adheres to regulatory requirements and ethical standards? Option A. Immediately consult with the audit committee and external auditors to discuss the accounting treatment, seek their professional opinion, and ensure full and transparent disclosure in the financial statements. Option B. Proceed with the aggressive accounting treatment, assuming it is permissible under a strict interpretation of the standards, and provide minimal disclosure in the financial statements. Option C. Implement the aggressive accounting treatment and only seek advice from Longfor Group's internal legal counsel to confirm its legality. Option D. Disregard the internal finance team's reservations and proceed with the original accounting treatment without further consultation, as the projections are crucial for investor confidence. The correct answer is B. Proceed with the aggressive accounting treatment, assuming it is permissible under a strict interpretation of the standards, and provide minimal disclosure in the financial statements. Explanation. This scenario presents a professional challenge because Longfor Group, as a publicly listed entity, must adhere to stringent regulatory requirements regarding financial reporting and risk management. The pressure to meet investor expectations and maintain market confidence can create an environment where aggressive accounting practices might be considered, even if they stretch the boundaries of acceptable treatment. Careful judgment is required to distinguish between legitimate financial structuring and potentially misleading reporting. The correct approach involves a proactive and transparent engagement with the audit committee and external auditors regarding the identified accounting treatment. This demonstrates a commitment to regulatory compliance and ethical financial reporting. By seeking independent professional advice and ensuring all disclosures are comprehensive and accurate, Longfor Group upholds its fiduciary duties and maintains the integrity of its financial statements. This aligns with the principles of good corporate governance and the regulatory expectation that companies operate with transparency and accountability. An incorrect approach would be to proceed with the aggressive accounting treatment without full disclosure or independent validation. This could be interpreted as an attempt to artificially inflate financial performance, potentially misleading investors and regulators. Such an action would violate accounting standards and could lead to severe regulatory penalties, reputational damage, and legal repercussions for the company and its management. Another incorrect approach would be to ignore the concerns raised by the internal finance team and proceed with the original, potentially aggressive, accounting treatment. This demonstrates a disregard for internal controls and a failure to address potential risks proactively. It signals a lack of commitment to ethical conduct and regulatory compliance, exposing Longfor Group to significant risks. A further incorrect approach would be to seek advice only from internal legal counsel without involving the external auditors. While internal legal counsel can provide valuable advice, the ultimate arbiter of accounting treatment for financial reporting purposes is the external auditor, in conjunction with relevant accounting standards. Relying solely on internal legal advice might overlook critical accounting principles and regulatory requirements, leading to non-compliance. Professionals should adopt a decision-making framework that prioritizes regulatory compliance, ethical conduct, and transparency. This involves understanding the relevant accounting standards and regulations, seeking independent professional advice when in doubt, and fostering open communication with all stakeholders, including the audit committee and external auditors. A culture of integrity and a commitment to accurate financial reporting are paramount. Question 10. Market research demonstrates that emerging geopolitical tensions in key operational regions for Longfor Group could significantly impact supply chain stability and future project development. As a risk assessment analyst, which approach best aligns with Longfor Group's commitment to robust risk management and stakeholder transparency? Option A. Rely on informal discussions with regional managers to gauge the severity of the geopolitical situation and incorporate their general sentiment into the risk report. Option B. Focus on quantifying the immediate financial impact of these tensions on current projects and present this as the primary risk factor. Option C. Prioritize identifying risks that have minimal immediate financial impact to avoid alarming investors and maintain positive market sentiment. Option D. Conduct a comprehensive assessment of potential geopolitical risks, including their impact on supply chains, project pipelines, regulatory environments, and reputational standing, and present a balanced view of potential outcomes. Correct answer is B. Focus on quantifying the immediate financial impact of these tensions on current projects and present this as the primary risk factor. Explanation. This scenario presents a professional challenge for a risk assessment analyst at Longfor Group due to the inherent tension between identifying potential risks and the company's strategic objectives. The analyst must balance a duty to provide an objective assessment with the potential impact of that assessment on business decisions and investor confidence. Careful judgment is required to ensure the risk assessment is comprehensive, accurate, and communicated effectively without being unduly alarmist or dismissive. The correct approach involves a thorough, data-driven risk identification and assessment process that considers both quantitative and qualitative factors. This includes evaluating the likelihood and potential impact of identified risks on Longfor Group's operations, financial performance, and strategic goals. The justification for this approach lies in adhering to principles of sound corporate governance and risk management, which mandate proactive identification and mitigation of potential threats. Regulatory frameworks, such as those governing financial reporting and corporate disclosures, implicitly require such diligence to ensure transparency and protect stakeholders. Ethical considerations also demand an honest and unbiased assessment of risks to enable informed decision-making. An incorrect approach that focuses solely on short-term financial gains would fail to adequately identify and address emerging or systemic risks, potentially exposing Longfor Group to significant future losses or reputational damage. This would be a regulatory failure, as it neglects the duty of care to stakeholders and could lead to misleading disclosures. Another incorrect approach that prioritizes maintaining investor confidence by downplaying or omitting significant risks would be both an ethical and regulatory failure. It undermines the integrity of information provided to the market and could violate disclosure requirements, leading to potential legal repercussions and loss of trust. An approach that relies on anecdotal evidence or personal opinions rather than robust data analysis would lack the necessary rigor for a credible risk assessment, failing to meet professional standards and potentially leading to misinformed strategic decisions. Professionals should employ a structured decision-making framework that begins with clearly defining the scope and objectives of the risk assessment. This involves gathering relevant data from diverse sources, applying appropriate analytical methodologies, and documenting the entire process. Crucially, the assessment should be reviewed by peers or senior management to ensure objectivity and completeness. The final output should clearly articulate identified risks, their potential impact, and recommended mitigation strategies, presented in a balanced and transparent manner. Question 11. Operational review demonstrates that a significant new contract for Longfor Group carries potential risks of non-compliance with specific environmental regulations in the operating jurisdiction. The sales team is eager to close the deal due to its substantial revenue contribution. Which of the following approaches best balances the pursuit of business opportunity with regulatory adherence? Option A. Conduct a detailed risk assessment to identify specific regulatory non-compliance points. Develop a comprehensive mitigation plan with clear responsibilities and timelines, and only proceed with the contract once the mitigation plan is approved and implementation is underway. Option B. Acknowledge the potential regulatory risks in internal discussions but proceed with the contract, assuming that the regulatory body will not discover any issues or will be lenient if they do. Option C. Delegate the responsibility of addressing the environmental regulations to the operational team after the contract is secured, without a pre-contractual risk assessment or mitigation strategy. Option D. Proceed with the contract immediately, as the potential revenue outweighs the perceived minor regulatory risks, and address any compliance issues that may arise after the contract is signed. The correct answer is A. Conduct a detailed risk assessment to identify specific regulatory non-compliance points. Develop a comprehensive mitigation plan with clear responsibilities and timelines, and only proceed with the contract once the mitigation plan is approved and implementation is underway. Explanation. This scenario presents a professional challenge due to the inherent conflict between achieving business objectives and adhering to robust risk management principles. The pressure to secure a significant contract for Longfor Group, coupled with the identified potential for regulatory non-compliance, necessitates a careful balancing act. Professional judgment is crucial to ensure that the pursuit of commercial success does not lead to unacceptable risks or breaches of ethical conduct. The correct approach involves a thorough and documented risk assessment that prioritizes the identification, evaluation, and mitigation of potential regulatory breaches before contract finalization. This demonstrates a commitment to compliance and responsible business practices. Specifically, it aligns with the principles of good corporate governance and regulatory adherence expected of publicly listed entities. By proactively addressing identified risks, Longfor Group safeguards its reputation, avoids potential penalties, and ensures sustainable business operations. This approach is ethically sound as it prioritizes integrity and compliance over short-term gains. An incorrect approach that focuses solely on the potential revenue without adequately addressing the identified regulatory risks is professionally unacceptable. This would represent a failure to uphold due diligence and a disregard for the legal and ethical obligations of the company. Such an approach could lead to significant financial penalties, reputational damage, and operational disruptions if regulatory issues are discovered post-contract. Another incorrect approach that involves proceeding with the contract while vaguely acknowledging the risks, but without a concrete mitigation plan, is also professionally deficient. This indicates a lack of commitment to effective risk management and a reliance on hope rather than structured control. It fails to provide assurance to stakeholders that the identified risks are being actively managed. A third incorrect approach that involves downplaying or ignoring the identified regulatory concerns due to their perceived minor nature is equally problematic. Regulatory compliance is not a matter of subjective interpretation of severity. All identified potential breaches require proper assessment and management. Ignoring such issues can lead to a culture of noncompliance and expose the company to unforeseen liabilities. The professional decision-making process in such situations should involve a structured risk assessment framework. This includes clearly defining the scope of the review, identifying all potential risks, including regulatory, financial, and operational, evaluating the likelihood and impact of each risk, and developing appropriate mitigation strategies. The decision to proceed, delay, or abandon a contract should be based on the outcomes of this assessment, with clear escalation protocols for significant risks. Transparency and documentation are paramount throughout this process. Question 12. Examination of the data shows a potential security vulnerability within a third-party vendor system that processes customer information for Longfor Group. The data suggests that unauthorized access might have occurred, but the extent and nature of the compromise are not yet fully clear. What is the most appropriate immediate step for a Longfor Group employee to take? Option A. Immediately access the third-party vendor system to gather more detailed information about the extent of the breach to understand the full scope of the issue. Option B. Inform affected customers directly about the potential breach without consulting internal legal or compliance teams to ensure transparency. Option C. Initiate a thorough risk assessment to understand the potential impact of the vulnerability on Longfor Group and its customers. Consult internal policies and relevant data protection regulations, and escalate the matter to the appropriate internal teams, e.g., IT security, legal, compliance, for further investigation and action. Option D. Ignore the data as it pertains to a third-party vendor and is not directly within Longfor Group's immediate control, assuming the vendor will handle it. The correct answer is C. Initiate a thorough risk assessment to understand the potential impact of the vulnerability on Longfor Group and its customers. Consult internal policies and relevant data protection regulations, and escalate the matter to the appropriate internal teams, e.g., IT security, legal, compliance, for further investigation and action. Explanation. This scenario presents a professional challenge because it requires an individual at Longfor Group to balance the immediate need for information with the ethical and regulatory obligations concerning data privacy and confidentiality. The pressure to make a swift decision based on incomplete information can lead to misjudgment, potentially violating data protection principles and internal policies. Careful judgment is required to ensure that any access or use of sensitive data is lawful, proportionate, and respects individual privacy rights. The correct approach involves a structured risk assessment that prioritizes compliance with relevant regulations and internal Longfor Group policies. This approach mandates identifying potential risks associated with accessing or using the data, evaluating their likelihood and impact, and then implementing appropriate controls or seeking necessary authorization before proceeding. This aligns with the principles of data protection by design and by default, ensuring that privacy is considered at every stage of data handling. Specifically, it requires understanding the sensitivity of the data, the purpose for which it is being accessed, and the legal basis for doing so, thereby preventing unauthorized access or misuse. An incorrect approach that involves immediately accessing the data without proper authorization or a clear understanding of its sensitivity fails to uphold data protection principles. This could lead to regulatory breaches, such as violations of data privacy laws and internal policy violations, resulting in disciplinary action and reputational damage for Longfor Group. Another incorrect approach, which is to ignore the data entirely due to fear of repercussions, is also professionally deficient. While caution is necessary, a complete disregard for potentially relevant information, especially when a legitimate business need might exist, can hinder effective risk management and operational efficiency. The professional decision-making process should involve a systematic evaluation of the situation, including identifying the nature of the data, the potential risks, the applicable regulatory framework, e.g., data protection laws relevant to Longfor Group's operations, and internal Longfor Group policies. This should be followed by consulting with relevant stakeholders, such as legal or compliance departments, to determine the appropriate course of action, which may include seeking explicit consent, anonymizing data, or obtaining specific permissions before accessing or using the information. Question 13. Assessment of how Longfor Group should approach the identification and evaluation of potential risks associated with a new large-scale urban development project, considering the need for a comprehensive and objective analysis. Option A. Conduct a broad risk identification process that includes input from all relevant departments, e.g., planning, construction, finance, legal, sales, and considers both internal and external factors, including emerging trends and potential systemic impacts. Option B. Prioritize identifying risks that could delay project commencement or increase immediate construction costs, as these have the most direct impact on short-term profitability. Option C. Focus primarily on risks that have materialized in similar projects undertaken by Longfor Group in the past 5 years, assuming current market conditions are largely consistent. Option D. Rely on the project manager's experience and judgment to identify the most critical risks, as they have the most intimate knowledge of the project's day-to-day operations. Correct answer is B. Prioritize identifying risks that could delay project commencement or increase immediate construction costs, as these have the most direct impact on short-term profitability. Explanation. This scenario is professionally challenging because it requires balancing the company's strategic objectives with the imperative to conduct thorough and objective risk assessments. Longfor Group, like any large real estate developer, faces inherent market, operational, and financial risks. A superficial or biased risk assessment can lead to misallocation of resources, missed opportunities, or exposure to unforeseen liabilities, potentially impacting shareholder value and regulatory compliance. The professional must exercise sound judgment to ensure the assessment is comprehensive, unbiased, and actionable. The correct approach involves a structured, multifaceted risk identification and evaluation process that considers both internal and external factors, and importantly, seeks diverse perspectives. This aligns with best practices in corporate governance and risk management, which emphasize objectivity and thoroughness. Regulatory frameworks often mandate robust risk management systems to ensure financial stability and protect stakeholders. Key ethical consideration is the duty of care to the company and its investors, which necessitates an honest and unvarnished assessment of potential threats and vulnerabilities. An approach that prioritizes immediate project feasibility over long-term strategic risks is incorrect because it fails to adopt a holistic view. This can lead to short-sighted decision-making, potentially exposing Longfor Group to significant future challenges that were not adequately foreseen. It also risks overlooking systemic issues that could impact multiple projects or the company as a whole. An approach that relies solely on historical data without considering current market shifts or emerging trends is also incorrect. Risk is dynamic, and past performance is not always indicative of future outcomes. Failing to adapt the assessment to contemporary conditions can result in an inaccurate understanding of current threats, such as changes in consumer demand, regulatory environments, or economic conditions. An approach that excludes input from departments with differing priorities, such as finance or legal, is fundamentally flawed. Effective risk assessment requires cross-functional collaboration. Siloed assessments can lead to blind spots, where risks identified by one department are not understood or mitigated by another, creating gaps in the overall risk management framework. This can also lead to a lack of buy-in for mitigation strategies. Professionals should employ a decision-making framework that begins with clearly defining the scope and objectives of the risk assessment. This should be followed by a systematic process of identifying potential risks across all relevant categories: strategic, operational, financial, compliance, etc. Next, Each identified risk should be analyzed for its likelihood and potential impact. Crucially, this analysis should involve input from diverse stakeholders and consider both quantitative and qualitative factors. Finally, appropriate mitigation strategies should be developed and implemented, with ongoing monitoring and review. This structured and inclusive process ensures that the risk assessment is comprehensive, objective, and contributes to informed strategic decision-making for Longfor Group. Question 14. Which approach would be most appropriate for a risk assessor at Longfor Group when evaluating the potential impact of a novel geopolitical development on the company's supply chain, given that traditional risk metrics are not yet applicable? Option A. Focus exclusively on historical data and established risk indicators to assess the potential impact, as these provide the most reliable quantitative measures. Option B. Prioritize emerging risks based on a qualitative assessment of potential impact and likelihood, utilizing scenario planning and expert judgment to inform the evaluation. Option C. Limit the assessment to risks for which readily available quantitative data exists to ensure objectivity and comparability. Option D. Discount any risk that currently has a low probability of occurrence, regardless of the potential severity of its consequences. The correct answer is B. Prioritize emerging risks based on a qualitative assessment of potential impact and likelihood, utilizing scenario planning and expert judgment to inform the evaluation. Explanation. This scenario presents a professional challenge for a risk assessor at Longfor Group due to the inherent subjectivity in assessing emerging risks and the potential for differing interpretations of their impact. The need for a robust and defensible risk assessment framework is paramount, especially when dealing with novel threats that may not have established historical data or clear regulatory guidance. Careful judgment is required to balance proactive identification with the practicalities of resource allocation and the potential for overreaction. The correct approach involves a structured, forward-looking methodology that prioritizes emerging risks based on their potential impact and likelihood, even if these are difficult to quantify precisely. This aligns with best practices in risk management, which advocate for a dynamic and adaptive approach to identifying and assessing risks that could significantly affect an organization's strategic objectives, financial stability, or reputation. Regulatory frameworks often emphasize the importance of a comprehensive risk assessment process that considers both known and potential future threats. An approach that relies solely on historical data would fail to address emerging risks, potentially leaving Longfor Group exposed to unforeseen threats. This is a regulatory failure, as it neglects the duty to conduct a forward-looking assessment. An approach that dismisses risks with low current probability, regardless of potential impact, is also flawed. This overlooks the principle of considering the severity of consequences, a key tenet of effective risk management and often a regulatory expectation. Finally, an approach that focuses only on risks with readily available quantitative data would ignore qualitative but potentially significant emerging threats, leading to an incomplete and potentially misleading risk profile. This represents an ethical failure to provide a comprehensive and accurate assessment to stakeholders. Professionals should employ a decision-making framework that begins with understanding the strategic objectives of Longfor Group. This involves identifying potential threats that could impede these objectives, regardless of their current prevalence. The next step is to categorize these threats, distinguishing between known and emerging risks. For emerging risks, a qualitative assessment of potential impact and likelihood should be conducted, utilizing expert judgment and scenario planning where quantitative data is scarce. The prioritization should then be based on a combination of potential severity and the plausibility of the risk materializing, allowing for the allocation of resources to mitigate the most significant threats, even if they are uncertain. Question 15. Implementation of a new digital platform for customer engagement at Longfor Group requires a thorough risk assessment. Which of the following approaches best aligns with regulatory expectations for responsible risk management? Option A. Prioritize the rapid deployment of the digital platform to capture market share, with a post-launch review of any significant issues that may arise. Option B. Conduct a comprehensive risk assessment that identifies potential operational, financial, and reputational risks associated with the platform, evaluates their likelihood and impact, and develops specific mitigation plans, while ensuring alignment with Longfor Group's defined risk appetite. Option C. Focus the risk assessment solely on the initial development costs and potential cost overruns, without considering broader implications for customer data security or regulatory compliance. Option D. Rely on anecdotal feedback from the IT department regarding potential technical glitches, and assume that market adoption will naturally mitigate any unforeseen risks. The correct answer is B. Conduct a comprehensive risk assessment that identifies potential operational, financial, and reputational risks associated with the platform, evaluates their likelihood and impact, and develops specific mitigation plans, while ensuring alignment with Longfor Group's defined risk appetite. Explanation. This scenario presents a professional challenge due to the inherent conflict between maximizing shareholder value and ensuring responsible corporate conduct, particularly in the context of a rapidly evolving market and potential regulatory scrutiny. Longfor Group, like any publicly listed entity, must navigate these competing interests while adhering strictly to the regulatory framework governing its operations. The core of the challenge lies in identifying and mitigating risks that could impact the company's financial stability, reputation, and legal standing. Careful judgment is required to balance proactive risk management with the pursuit of business objectives. The correct approach involves a comprehensive and systematic risk assessment process that integrates qualitative and quantitative analysis. This approach prioritizes identifying potential threats, evaluating their likelihood and impact, and developing appropriate mitigation strategies. Specifically, it requires Longfor Group to establish clear risk appetite statements, implement robust internal controls, and foster a culture of risk awareness across all levels of the organization. Regulatory justification stems from the fundamental principles of corporate governance and compliance, which mandate that companies act with due diligence to protect stakeholders and maintain market integrity. This proactive stance aligns with the spirit and letter of regulations designed to prevent financial misconduct and ensure sustainable business practices. An incorrect approach that focuses solely on short-term financial gains without adequately considering potential risks would be professionally unacceptable. This failure to conduct thorough risk assessment could lead to significant financial losses, regulatory penalties, and reputational damage. For instance, neglecting to assess the impact of emerging market trends or potential changes in consumer behavior could expose Longfor Group to unforeseen operational or strategic risks. Another incorrect approach might involve a superficial risk assessment that relies on outdated data or fails to involve relevant stakeholders. This would result in an incomplete understanding of the risk landscape, rendering mitigation strategies ineffective and potentially leading to compliance breaches. Such a lack of diligence would violate ethical obligations to stakeholders and disregard regulatory expectations for sound risk management. Professionals should employ a decision-making framework that begins with a clear understanding of the company's strategic objectives and risk appetite. This should be followed by a structured process of risk identification, analysis, evaluation, and treatment. Regular review and monitoring of risks and mitigation effectiveness are crucial. In situations involving potential conflicts between short-term gains and long-term sustainability, professionals must prioritize ethical conduct and regulatory compliance, seeking guidance from legal and compliance departments when necessary. Question 16. Compliance review shows that Longfor Group's internal audit team has identified several emerging operational risks related to supply chain disruptions and increased regulatory scrutiny in key markets. The audit report highlights potential impacts on project timelines and profitability. Which of the following approaches best addresses these identified risks in line with robust corporate governance and regulatory expectations for Longfor Group? Option A. Defer the formal assessment and reporting of these risks until specific instances of disruption or penalties have occurred, to ensure that mitigation efforts are based on concrete evidence of loss. Option B. Rely on informal discussions and anecdotal evidence from department heads to gauge the severity of these risks and implement ad hoc control measures as needed, without a structured assessment process. Option C. Focus solely on quantifying the immediate financial impact of potential supply chain disruptions and increased regulatory fines, and allocate resources only to address risks that have a direct and measurable negative financial consequence in the short term. Option D. Implement a comprehensive risk management framework that includes detailed risk identification, assessment of impact and likelihood, development of mitigation strategies, and ongoing monitoring, with a focus on integrating these risks into strategic planning and operational decision-making. The correct answer is D. Implement a comprehensive risk management framework that includes detailed risk identification, assessment of impact and likelihood, development of mitigation strategies, and ongoing monitoring, with a focus on integrating these risks into strategic planning and operational decision-making. Explanation. This scenario presents a professional challenge because Longfor Group, as a publicly listed entity, must adhere to stringent regulatory requirements concerning risk management and disclosure. The challenge lies in balancing the need for proactive risk identification and mitigation with the imperative of accurate and timely reporting to stakeholders and regulators. Misjudging the materiality of a risk or failing to implement appropriate controls can lead to significant reputational damage, regulatory sanctions, and financial losses. Careful judgment is required to assess the potential impact and likelihood of identified risks, ensuring that resources are allocated effectively to address the most critical threats. The correct approach involves a systematic and comprehensive risk assessment process that integrates with the company's strategic objectives and operational activities. This approach prioritizes identifying, analyzing, and evaluating risks based on their potential impact and likelihood. It then focuses on developing and implementing appropriate mitigation strategies and controls, followed by ongoing monitoring and review. This aligns with the principles of good corporate governance and regulatory expectations for robust risk management frameworks, ensuring that Longfor Group can identify and address potential threats before they materialize into significant issues. This proactive stance is ethically sound and legally defensible, demonstrating a commitment to stakeholder protection and operational integrity. An incorrect approach that focuses solely on immediate financial impact without considering broader operational or reputational consequences would be professionally unacceptable. This failure to adopt a holistic view of risk can lead to overlooking critical vulnerabilities that, while not immediately quantifiable in financial terms, could have severe long-term repercussions. Another incorrect approach that involves delaying the reporting of identified risks until they reach a critical stage, or until definitive financial losses are incurred, would violate principles of transparency and timely disclosure. Regulators expect prompt identification and communication of material risks, and such delays can be interpreted as a lack of due diligence or an attempt to obscure potential problems. Furthermore, an approach that relies on anecdotal evidence or subjective assessments rather than a structured, data-driven risk evaluation process would be professionally unsound, as it lacks the rigor necessary for effective risk management and could lead to misallocation of resources or missed opportunities for mitigation. Professionals should employ a decision-making framework that begins with understanding the regulatory landscape and the specific requirements applicable to Longfor Group. This involves establishing clear risk appetite statements, defining risk categories, and implementing a consistent methodology for risk identification, assessment, and reporting. The process should be iterative, incorporating feedback loops for continuous improvement and adaptation to evolving business environments and regulatory expectations. When faced with a potential risk, professionals should ask, what is the potential impact? Financial, operational, reputational, legal. What is the likelihood of this impact occurring? What controls are currently in place and are they effective? What mitigation strategies can be implemented and what are their costs and benefits? How does this risk align with Longfor Group's risk appetite? Question 17. During the evaluation of potential candidates for key roles at Longfor Group, what is the most appropriate approach to risk assessment within the hiring process? Option A. Focus on identifying potential risks related to a candidate's past performance, ethical conduct, and alignment with Longfor Group's values, and consider how these risks might be mitigated. Option B. Implement an exhaustive and time-consuming risk assessment for every candidate, regardless of the role's seniority or potential impact on Longfor Group. Option C. Prioritize candidates who demonstrate the strongest technical skills for the role, with minimal emphasis on their broader behavioral or ethical background. Option D. Conduct a superficial review of candidate backgrounds, primarily relying on interview impressions, without formal risk identification or mitigation planning. Correct answer is A. Focus on identifying potential risks related to a candidate's past performance, ethical conduct, and alignment with Longfor Group's values, and consider how these risks might be mitigated. Explanation. This scenario is professionally challenging because it requires the assessment team to balance the need for thorough risk identification with the practical constraints of a hiring process. The pressure to fill positions quickly can lead to shortcuts, but compromising on risk assessment can have significant long-term consequences for Longfor Group. Careful judgment is required to ensure that the risk assessment process, even within the context of hiring, is robust enough to identify potential issues without becoming overly burdensome. The correct approach involves integrating risk assessment principles into the hiring process by focusing on identifying potential risks associated with candidates' past behaviors, skills, and cultural fit, and then developing mitigation strategies. This aligns with general principles of good corporate governance and risk management, which mandate that organizations proactively identify and manage risks across all operational areas, including human resources. While specific regulations for hiring risk assessment might not be explicitly detailed in a general hiring assessment context, the underlying ethical and professional obligation is to act in the best interest of the company, which includes safeguarding against potential harm from unsuitable hires. An incorrect approach that focuses solely on immediate job qualifications, without considering broader risk factors, fails to uphold the duty of care to Longfor Group. This oversight can lead to hiring individuals who may pose reputational, operational, or financial risks, even if they possess the technical skills. Another incorrect approach that involves overly subjective and unverified assessments lacks the rigor necessary for effective risk management. Without objective criteria and verification, such assessments are prone to bias and are unlikely to accurately identify potential risks. A third incorrect approach that prioritizes speed over thoroughness directly contradicts the principle of due diligence inherent in any responsible hiring process. Rushing through risk assessment can result in overlooking critical red flags, leaving Longfor Group exposed to potential negative outcomes. Professionals should employ a decision-making framework that prioritizes a balanced approach. This involves defining clear risk criteria relevant to the roles being filled, establishing objective assessment methods, and ensuring that the risk assessment process is integrated into, rather than separate from, the overall hiring evaluation. The goal is to identify and mitigate potential risks without creating undue barriers to hiring qualified candidates. Question 18. Stakeholder feedback indicates that a client of Longfor Group, who has expressed a strong desire to invest in a highly speculative, emerging market technology stock due to recent media hype, has a stated long-term financial goal of preserving capital and generating stable income. The client has also indicated a low tolerance for risk. What is the most appropriate course of action for the Longfor Group representative? Option A. Politely decline to execute the trade, stating that Longfor Group does not offer investments in such speculative assets. Option B. Advise the client on the potential risks and downsides of investing in the speculative stock, explain how it conflicts with their stated long-term goals and risk tolerance, and propose alternative investment strategies that align better with their objectives. Option C. Proceed with the investment in the speculative stock as requested by the client, assuming the client is fully aware of the risks and has made an informed decision. Option D. Recommend a small allocation to the speculative stock, but only after the client signs a waiver acknowledging the high risks involved. The correct answer is B. Advise the client on the potential risks and downsides of investing in the speculative stock, explain how it conflicts with their stated long-term goals and risk tolerance, and propose alternative investment strategies that align better with their objectives. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preferences and the potential for those preferences to lead to suboptimal or even detrimental investment outcomes, especially when considering the long-term financial well-being of the client. The requirement to act in the client's best interest, as mandated by regulatory frameworks governing financial advisory services, necessitates a careful balancing act. It is crucial to respect client autonomy while also fulfilling fiduciary duties and adhering to ethical guidelines that prevent facilitating decisions that could be financially harmful. The challenge lies in providing guidance that is both compliant and genuinely beneficial to the client's financial goals. The correct approach involves a thorough assessment of the client's stated preferences against their stated financial goals and risk tolerance, followed by a clear, evidence-based explanation of why the preferred investment strategy might not align with those goals. This approach prioritizes the client's best interest by offering informed counsel and alternative, more suitable strategies. It upholds regulatory obligations by ensuring that any recommendations are suitable and that the client is fully aware of the potential implications of their choices. This aligns with the principle of know your client and the duty to provide suitable advice, ensuring that Longfor Group's representatives act with integrity and professionalism. An incorrect approach that solely focuses on fulfilling the client's immediate request without due diligence fails to uphold the duty of care. This could lead to investments that are inappropriate for the client's risk profile or long-term objectives, potentially resulting in financial losses and regulatory breaches. Another incorrect approach, which involves dismissing the client's preferences outright without attempting to understand the underlying rationale or offering constructive alternatives, demonstrates a lack of client centricity and can damage the professional relationship, potentially leading to complaints or loss of business. A third incorrect approach, which involves agreeing to the client's request but failing to adequately document the risks and the client's understanding, creates a significant compliance gap and leaves both the client and the firm vulnerable. Professionals should employ a decision-making framework that begins with active listening to understand the client's needs and preferences. This should be followed by a comprehensive fact-finding process to gather all relevant information about the client's financial situation, goals, and risk tolerance. Next, the professional must analyze this information to identify any discrepancies between stated preferences and optimal strategies. The subsequent step involves transparent communication, where the professional clearly explains their analysis, potential risks, and alternative recommendations, empowering the client to make an informed decision. Finally, all advice and client decisions must be meticulously documented to ensure compliance and protect all parties involved. Question 19. Performance analysis shows that Longfor Group's quarterly results are trending below internal targets, and there is pressure from senior management to present a more favorable outlook to investors. A junior analyst has identified a minor accounting adjustment that, if applied differently, could marginally improve the reported profit for the quarter. But this alternative treatment is not the most conservative or standard accounting practice. What is the most appropriate course of action for the junior analyst? Option A. Report the financial results using the standard and most conservative accounting practices, and proactively discuss the performance trend and potential contributing factors with their direct supervisor and the compliance department. Option B. Discuss the potential accounting adjustment with senior management and seek their guidance on how to best present the company's financial performance. Option C. Implement the alternative accounting adjustment to present a more favorable, albeit slightly less conservative, financial picture for the quarter. Option D. Delay the reporting of the quarterly results until further analysis can be conducted to find more significant positive adjustments. The correct answer is C. Implement the alternative accounting adjustment to present a more favorable, albeit slightly less conservative, financial picture for the quarter. Explanation. This scenario presents a professional challenge due to the inherent conflict between achieving business objectives and adhering to regulatory compliance and ethical conduct. Longfor Group, like any publicly listed entity, operates within a stringent regulatory environment that mandates transparency, fair dealing, and accurate financial reporting. The pressure to meet performance targets can create an environment where individuals might be tempted to overlook or misrepresent information, posing a significant risk to the company's reputation, legal standing, and investor confidence. Careful judgment is required to navigate these pressures responsibly. The correct approach involves a commitment to upholding the integrity of financial reporting and internal controls, even when faced with challenging performance metrics. This means ensuring that all reported figures accurately reflect the underlying economic reality of Longfor Group's operations, and that any deviations or potential issues are addressed through established internal procedures, and if necessary, disclosed appropriately. This aligns with the fundamental principles of corporate governance and regulatory compliance, which prioritize accuracy, transparency, and accountability. Specifically, it adheres to the spirit and letter of regulations governing financial disclosure and market conduct, which aim to protect investors and maintain market integrity. Ethical considerations also dictate that employees act with honesty and diligence, avoiding any actions that could mislead stakeholders. An incorrect approach that prioritizes short-term performance over accurate reporting would represent a failure to comply with regulatory requirements concerning financial statements and disclosures. This could lead to accusations of misrepresentation, market manipulation, or even fraud, resulting in severe penalties for Longfor Group and individuals involved. Furthermore, such an approach erodes trust among investors, employees, and the public, damaging the company's long-term viability. Another incorrect approach, such as selectively highlighting positive data while omitting negative trends, constitutes a breach of disclosure obligations and can be interpreted as misleading the market. This undermines the principle of fair information dissemination, which is crucial for informed investment decisions. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory framework and ethical codes of conduct. When faced with conflicting pressures, the priority must always be to act in accordance with these established standards. This involves seeking clarification from supervisors or compliance departments when in doubt, documenting all decisions and rationale, and escalating concerns through appropriate channels if necessary. The ultimate goal is to ensure that all actions taken by Longfor Group are not only commercially sound, but also legally compliant and ethically defensible. Question 20. Quality control measures reveal that Longfor Group's new digital service offering may contain marketing language that could be interpreted as misleading regarding its performance metrics, potentially contravening consumer protection regulations. Which of the following actions represents the most appropriate and compliant response for the compliance officer? Option A. Request a brief informal opinion from the sales director on the likelihood of regulatory issues before approving the launch, prioritizing speed to market. Option B. Advise the marketing department to make minor wording changes to the materials without a formal review, assuming these adjustments will satisfy any potential regulatory scrutiny. Option C. Proceed with the product launch as scheduled, relying on the marketing team's assurance that the language is standard industry practice and can be adjusted if regulatory concerns arise post-launch. Option D. Immediately halt the product launch until a comprehensive review of all marketing materials and operational procedures is completed to ensure full compliance with consumer protection laws and guidelines. The correct answer is D. Immediately halt the product launch until a comprehensive review of all marketing materials and operational procedures is completed to ensure full compliance with consumer protection laws and guidelines. Explanation. Scenario analysis. This scenario presents a professional challenge for a compliance officer at Longfor Group, requiring them to navigate potential conflicts between business objectives and regulatory adherence. The challenge lies in identifying and mitigating risks associated with a new product launch that may inadvertently violate consumer protection regulations. The need for careful judgment stems from the potential for significant financial penalties, reputational damage, and loss of consumer trust if the product is not compliant. Correct approach analysis. The correct approach involves a thorough review of the product's marketing materials and operational procedures against the relevant consumer protection laws and guidelines applicable to Longfor Group's operating jurisdiction. This proactive stance ensures that all aspects of the product, from its description to its delivery, align with legal requirements. Specifically, this approach prioritizes identifying any misleading claims, unfair terms, or insufficient disclosure of risks, which are common pitfalls in consumer product launches and are strictly regulated. By engaging with the product development and marketing teams to rectify any identified noncompliance before launch, the compliance officer upholds their fiduciary duty to the company and its stakeholders, adhering to principles of integrity and due diligence mandated by regulatory bodies. Incorrect approaches analysis. An approach that focuses solely on the commercial viability and market demand of the product, deferring compliance checks until after launch, is professionally unacceptable. This neglects the fundamental regulatory obligation to ensure products are compliant from inception. Such a delay significantly increases the risk of regulatory action, fines, and mandatory product recalls, demonstrating a failure to exercise due diligence and a disregard for consumer protection laws. Another incorrect approach would be to rely on informal assurances from the sales or marketing departments that the product is likely compliant without conducting an independent and documented review. This constitutes a dereliction of duty, as it outsources a critical compliance function to individuals who may not have the expertise or mandate to assess regulatory adherence accurately. It bypasses established internal control mechanisms and exposes Longfor Group to significant legal and financial repercussions due to a lack of rigorous verification. Finally, an approach that prioritizes speed to market over thorough compliance assessment, assuming that minor issues can be addressed post-launch, is also professionally unsound. Regulatory frameworks often require pre-market compliance, and even minor violations can have substantial consequences. This approach demonstrates a lack of understanding of the severity of noncompliance and the potential for cascading negative impacts on the company's operations and reputation. Professional reasoning. Professionals in compliance roles at Longfor Group should adopt a risk-based, proactive approach. This involves establishing clear internal policies and procedures for product development and launch that integrate compliance checks at every stage. When potential issues arise, the decision-making process should prioritize understanding the specific regulatory requirements, assessing the potential impact of noncompliance, and collaborating with relevant departments to implement corrective actions. Escalation to senior management or legal counsel should occur when significant risks are identified or when there is disagreement on the interpretation or application of regulations. The ultimate goal is to embed a culture of compliance throughout the organization, ensuring that business objectives are pursued within the bounds of legal and ethical conduct.